Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. Welcome to another episode of our series on India Market Outlook 2023 titled Playing It Safe. In today's episode, we discuss our views on bonds. Indian government bond yields have risen across the curve in 2022 as the RBI and other global central banks normalized pandemic-era liquidity and raised policy rates at an unprecedented pace to control inflation. This has led to a suboptimal performance for fixed income allocations for 2 consecutive years. Going into 2023, we are neutral on bonds as attractive absolute and real yields are counterbalanced by lower yield premiums, weak fiscal dynamics, and worsening government bond demand and supply balance. Rising interest rates remains a key headwind for bonds. In our assessment, government bonds and high-quality corporate bonds are attractive, offering higher carry and better risk-reward given the likelihood of tight financial conditions persisting in 2023. India's inflation-adjusted real yield currently is at 1.3%, better than the average real yield of negative 0.8% for other emerging markets. On the other hand, yield premiums, which we measure as the spread between 10-year Indian government bond yield and the policy repo rate, is trading below average, with the current spread closer to 100 basis points versus the 5-year average of 176 basis points. Within bonds, we are overweight short maturity bonds for the following reason. 1. In response to the RBI's policy action, yields at the shorter end have risen higher than the longer end. A flattening yield curve has improved the yield carry for them, improving the risk reward for short maturity bonds compared to medium to long maturity bonds. And second, given their lower sensitivity to rising interest rate scenario. However, we remain cognizant of 3 factors that remain unfavorable for bonds. First, fiscal deficit is likely to remain high over the medium term. Second, worsening government bond and demand supply balance given high supply of government bonds amid a lack of support from the RBI and muted demand by institutional investors, especially foreign investors. The government pegged its net borrowing for fiscal year 23 at about INR 11.6 trillion, the highest in many years. Third, high inflation and policy rate hikes by the RBI and US Fed are likely to exert upward pressure on bond yields. That's it in this episode. Do reach out to your relationship manager for a copy of our India Market Outlook 2023. And thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered relationship manager or visit www.se.com/in.